Welcome to Season's blog, The Leverage Contagion, how Yield 3.0 offers a haven against liquidation cascades. On May 28, 2026, a series of drone and missile strikes near the Strait of Hormuz triggered a systemic liquidity shock. Within 24 hours, global stock markets shed billion in coordinated equity deleveraging. Japan's Nikkei 225, for example, fell 1.4%, while South Korea's Kospi tumbled 3.2%. Brent crude oil spiked to $97.64 per barrel. Leverage traders in crypto lost nearly $1 billion in total liquidations. This crisis and other liquidation cascades that preceded it since October 2025 exposed a deeper systemic reality. Modern financialization has embedded fragile, reflexive leverage loops across all asset classes, turning self-sovereign hedges and traditional reserves into highly correlated, high-beta liquidity proxies. And against this backdrop, we can see how, in a globally correlated deleveraging cycle, a true safe haven is not merely an asset that falls the least, but a liquid cash flow mechanism that's resilient to devastating cascades by design, with no underlying position to call. That's what Yield 3.0 unlocks, the Noah's Ark for modern finance, the uncallable, unstoppable liquid haven that builds lasting wealth through ceasefire or escalation, war or peace, bull or bear, betting on borrowed money and the dark side of institutional adoption. Some of the most violent market drawdowns in recent years happened when leverage met a price it could not survive. Because when borrowed capital is stacked high enough, assets don't need to collapse for things to go haywire. They only need to wobble. Margin calls do the rest, converting forced sales, aka liquidations, into a self-reinforcing chain reaction. 93% of crypto's wreckage on May 28th involved leveraged long positions, with 167,000 plus trader accounts getting force closed. 10 days earlier, $563 million in similar bullish bets got wiped in a single session, the largest one-day clearout since February 6th, when a drop towards $60,000 erased $1.84 billion. These were, however, the aftershocks of October 10th, 2025, the biggest liquidation in crypto's history, 9 times larger than any single day before it. When a single tariff headline drained $19+ billion across 1.6 million accounts, fueled by $217 billion in open interest. Meanwhile, the comfortable buffer that once existed between traditional finance and decentralized markets has also broken down. The same forces that devastated crypto also hit stocks, government bonds, and even precious metals. Long-dated treasuries spiked to their highest in a year, which hurts existing holders, while silver shed 7% in a single session. The 60/40 portfolio, the one built to cushion you when stocks fall, didn't provide any respite, as the IMF had warned months ago. Stock-bond diversification now offers less protection during sell-offs, because the two assets move down together when funding tightens. Traditional risk parity funds and leveraged macro books thus face the same forced liquidation engines. The hedges stopped hedging. That said, there's an elephant in the room. Why does crypto now move in lockstep with traditional assets and instruments, whereas it was supposed to be their antithesis and fix the perennial flaws of legacy financial systems? The answer lies in identifying the structural trap of the institutional era that crypto has entered over the past year. In onboarding Wall Street's capital, DeFi also imported its plumbing. Now, when macro volatility spikes, automated portfolio risk models treat Bitcoin not as a store of value, digital gold, but as a high beta growth proxy that they programmatically dump to cover traditional margin calls. Further, rather than stabilizing markets, spot ETFs wrapped physical supply in centralized paper representations, thereby enabling synthetic leverage. Now, when shipping lanes wobble, they trigger the algorithmic risk-off engines, and crypto order books are used as global ATMs. The result is a single, hyper-correlated risk loop, the sanctuary of Yield 3.0's uncallable cash flow. In the volatility illusion, we dissected how volatility harvesting vaults and delta-neutral strategies fail during market flushes. Automated hedging algorithms are constrained by block times and lag behind the speed-of-light matching engines of centralized exchanges, converting expected safety into permanent capital destruction. The leverage flush of May 28th demonstrated that this vulnerability is systemic. Anything built on over-borrowed capital, dynamic hedging, or credit loops is a slippery slope. When prices fall, collateral shrinks, forcing liquidations that drive prices lower. To be truly all-weather proof, a cash flow architecture must therefore be decoupled from directional price action, debt loops, and rebalancing cues. This is a core structural component around which we laid the foundation of Yield 3.0 and designed other aspects of the protocol. Nearly 66% of the total seized supply, for instance, is locked out of circulation, unlike tokens that run purely on speculation. There's also no central credit pool to run on, so the protocol is practically immune to bank runs and cascading margin calls. Payouts don't rely on debt loop leverage or on speculative emissions either. The TTT module's volume times velocity engine captures a 10% fee on every seized transaction, buy, sell, transfer, and distributes it as yield to nodes while it's holding 10,000 plus Cs in 3 liquid assets: wrapped Bitcoin, WBTC, tokenized gold, XAUT, and yield-bearing stablecoin, JLUSDC. And these land directly in your wallet, so there's no need to deposit, stake, or claim. Your Cs never leaves your wallet. Your yield flows right into it. Because no margin is borrowed and no collateral is pledged to generate yield, there is no position to liquidate. That's precisely why Seasons has completed 50 distribution rounds, twice weekly, week after week, while billions of dollars were being liquidated left and right. $186,556 plus and counting. Still day one. Yes, Seas trades in the open market and may move with macro currents. There's no such thing as a token that's 100% immune to spot price action. But the digital native cash flow system that Yield 3.0 is, that's fully immune to the short-term price of Seas or any other asset. The cash flow is derived from real economic activity in a way that works regardless of market direction. And most importantly, it's not built on borrowed foundations. Just like yield from emissions, yield from borrowed leverage is a draw against time. It works until the capital turns, then it unwinds in minutes. Yield from fees is cash flow, and it compounds through the very storm that liquidates everyone else. Leverage cascades will keep coming. Deleveraging cycles will continue to flush global equities, bonds, and crypto portfolios alike. Your only true and lasting defense, your key to building and preserving wealth, is owning a productive value stream that has nothing to liquidate. Exit the casino. Join the sanctuary. Seize the moment. Seize the yield, and just let it grow.